All right. So this is just gold. That's all I'm going to talk about on this little one. That's because it's been the mover in the market so far, anyway. It's about 1:15 Australian time, so the US hasn't opened yet. US cash market has opened. The US futures are open. Right. So essentially, I'm a bit of a macro trader, right? For me, the most of the cash I make out of futures positions that I've been sitting on for months, maybe weeks, but generally months. I do a bit of punting around, like intraday, but generally for me, like it is like 90% of what I make is out of, you know, 2% of the positions, right? And that's not unusual for traders where you have a few positions where you just pick it and you get right and you ride it. Intraday trading, to me, is really it's a mugs game. Actually, it's a mugs game. Remember when I worked at the bank, the head of foreign exchange. That business made hundreds of millions of dollars, right? He had a lot of traders all over the world. He said even his best traders get it right 50% of the time at best. Right? In Australia, there's quite a good insider trading case for some guys were trading FX and they were getting a hit rate of like 90%, and the broker picked them up and said, mate, they've got to be insider trading. Generally, like if you're a trader and you're getting like above a 50% success rate, you're doing really well. People who say there's systems out there that have got like 70, 80, 90% success rates, they're full of shit, right? They're lies. Because if they had those systems, they could take their track record to any single bank or hedge fund on the face of the planet, and they could earn like $100 million every year, year after year after year, right? But instead, they're trying to sell you stupid little shitty courses for like $7, market value 2,000. That's what they're trying to do. Those things, they're unicorns. They do not exist. It's a con. Anyway, end of rant. So for me, like I'm a macro trader, as I said, my hit rate, it's like 50% across the whole position. And that's over the course of like a long term. The positions that I've got at the moment that have been making money, a short 10-year Australian bonds since January last year, short 2-year treasuries since October last year, short the bunds, right? That's since February, so that's like just a couple of weeks. But those ones I'm going to hang on to. They're the ones that I've really been, this year made good money out of. More recently, long the Aussie SPY, and that's since January, so that's been about a month, right? They're my positions that I've been actually making most of my money out of this year, right? That's it. So some of them are quite recent. But anyway, this is gold because I'm really quite bearish on gold, but it has been a mover. So I wanted to look at it. So and I guess with trading, it's about getting your opinion, right, compared to the price action in the market, and then joining those dots with a position, right? So if your view is not in sync with what the market is doing, there's no point putting a position on in my mind. Those three have to be in sync. If you've got a view and you've got a position on the view, but you're not paying attention to what the market is doing, which I've done plenty of times, right? You lose money like there's no tomorrow, right? But when they are in sync, which I've been, for example, on the bonds, right, where my view and position and the market pricing have been in sync, then it's there's money for jam, right? But that's essentially the knack. So this is my really macro view on gold, right? And then, so we've got down here, we've got the 2-year rates, 2-year US bonds, and up here we've got the gold rate. This obviously is not the complete picture because you've got to look at the 10s as well, and arguably you've got to look at inflation as well. Not arguably, you actually do. But what we've seen, which you might have seen before, is here, right? We've got a substantial low in gold, right? And it lines up basically perfectly with a high in gold back in 2011, right? So as rates came down, you know, they hit a low. This is the stupid app I use, right? Stupid website. As they hit a low, gold hit a peak. So rates low, gold high, right? You can see here, see this point here, right? When it broke through this level, going back, I won't do it here because it puts things out of sync. When it broke through this level here, what happened, right? Gold started to tick up, right? So yields started breaking down, gold went up. Yields hit a rock bottom low, gold hit a ding dong high. Yields stuffed around going sideways, gold had a consolidation. Right? Yields started ticking up, right, just here. You can see it's literally the week. Yields started ticking up here, gold started ticking down. Right? Yields went all the way up to here, right? And it's here when yields started, and then you can see as yields went up here, gold really, it kind of went down to sideways, right, the best. When, like at this little point in here, when gold finally started to tick up again, that's when yields peaked and started to turn, right? So as yields started to turn down, gold went up. And here we can see here, when yields really went down, right, gold shot up. This, of course, was the COVID liquidation debacle, right, where people were selling gold to fund essentially margin calls, right? It was just a run to cash, right? But yields went down, gold went up, and what happens here? Groundhog Day. Look at that. Look at that, how it lines up. Yields hit a record low there, gold hit another high here, right? And then it's in yields started going up, right here, see? Right, here it is in here. You know, started going up, gold started going down there. But again, in here, you can really see there's a bit of a, generally, there's a consolidation here, and gold kind of has another bit of a consolidation there. Now, so you can see all along here, the history is yields down, right? Gold starts breaking up, right? Yields all the way down to a low in the yields. Gold has gone up to a high. Yields consolidate, gold goes sideways, and it has this pattern which is very much, whoops, if I can get it going, very much like a series of lower highs against a neckline, right? And that consolidation period. Then yields start ticking up, right? Gold starts going down. Yields hit a high, right, and start turning. Gold starts heading higher. Right? Yields really kind of hit a low, another one. Gold hits a high. Consolidation kind of here in the yields. Gold has a series of lower highs against a neckline. Now the odd one out here, of course, is yields have started to tick up here substantially, and gold's been hanging in there. Right? Now there's a couple of reasons for that. One, to me, is the late money in the inflation trade. So you've got to remember, inflation is a backward-looking statistic, right? So when we look at inflation, and it's a long way backwards, so when we look at inflation now, it's saying it's 7.5%. That's inflation for the last 12 months, right? So when these rates are dropping down here, right, and gold is going up, what's going on? Right, people are going, rates are going down, the Fed's pumping money in, right? The government is doing a lot of fiscal stimulus. What's that going to do? Oh, that's going to create inflation. So what do I need? I need to hedge against that. So they buy gold here. Gold goes up as rates go down. They make money on gold to counter for the inflation that is then going to happen. Okay. People forget, right, that the inflation trade and the sense of inflation coming was back here. Okay, the same as here, right? As the rates start coming down, everyone knows that's going to fuel inflation. So what happens? Gold goes up as rates go down. I mean, gold is an inflation trade as well as an interest rates kind of thing, right? Lower rates, higher gold. Higher rates, lower gold, right? Higher inflation, higher gold, right? But there's a lag in that, okay? And this is the lag. where you've got inflation to come, but gold reads it early, okay? Because inflation is looking backwards, and gold, this is a spot price. So we're in here, like there's been some little spikes as we've got those inflations coming through, but nothing like this kind of move, and that's because inflation has largely been priced in. We're only really going to see an inflation spike here is if it spikes way above people's expectations. People's expectations are high, right? So that's the first reason why gold is up here, and why it's staying up here. I think it's dumb money late to the inflation trade. Inflation will pass, right? The Fed will counter it one way or another, and gold will come back on the back of that through lower inflation and higher rates. The reason why I think it's kind of holding up here, right, is a bit of the dumb money to the late inflation trade, but also the second thing is it's the safe haven, and more recently it is the Ukraine situation. If there's war going on, if there's global threats going on, whether it's like 9/11, whatever, people go to gold, and that's really what we've seen. That too is going to pass, and I think we're going to see gold drop back as a result of that. So that's with interest rates and gold, right? Now, if we just look at it a bit more closely, right? Now, I'm a big believer in gold. You've got to look at it weekly because it is such a macro beast. This noise I'll wipe out here, and we can look at this trend line here on a few bases, right? That's one basis. I normally, like particularly on weeklies, wipe out these candles, like the wicks, and just look at it like that, right? And you can see when you just look at it with the lines, it becomes it crystallizes. It makes a few things a whole lot clearer, right? So that's going on, right? And at the moment, we have broken this pattern, okay? Now, we've broken that high. We certainly haven't broken that high. And so, to me, this still isn't, to me, a compelling break. Now, I have had a short position gold. I stopped out around about 1860. It's like about here, 1860, something like that. When it popped out, that was on Saturday morning Australian time, when my broker called me at like 7 a.m. and said, something about Russia, Ukraine, blah, blah. And I said, right, that's it. Get me out of a gold position because I know that's going to spike, which it has. But again, that was because my view was short, my position was short, the market was rallying. So I said, well, and with the Ukraine-Russia tension, I thought, right, that's it. My view and my position are not in sync with what's going on in the market. Pull the pin. So that's what I've done. As a small position, right? So, and I am looking to re-establish it. I guess the question is where and when to do that, and this is where patience comes in. Now, I'm wary of that this whole thing with Russia and Ukraine could pass pretty quickly. And when we look at gold, just the action here of late, right? We can see these spikes, right? They are, like all of them, they're kind of pretty similar, right? They don't last long. They're pretty impulsive. That's the longest one, right? They don't last long, and then they come back. And that's another reason why I'm skeptical on this one. I guess it's same on the dips, right? Like they're pretty short, sharp dips. Bit less so because there's a lot more time hanging around here, like on some of these dips, than the spikes. But I look at the spikes and I'm going, that one turned around. That's like 3 days. This one kind of 3 or 4 days. This one's a lot longer. Like it's probably like 3 weeks or something. It's about a week. This could just be a couple of days. Even that was like 3 or 4 days. So I'm skeptical about whether that's going to last. and on that basis, I am waiting to pull the trigger and maybe catch it on the way down. Now you can see that on a shorter time frame, this is 4 hourly. Let me just get rid of these again. It has done a couple of good little technical things which some people will really like. There's this level here, right? You can see through here there's a whole lot of, that was the high. And here it's done a bit of a classic, like up here, support, plummets through, resistance comes up here, shoots through, hits that high, bounces off it, hits that one, and off it shoots. To me, that looks like a bit of stoppy action going on, particularly the way it shot through this 1830 mark. There would have been a lot of stops in there. That's a level a lot of people were looking, and you can see in here, it's done that the same little S bend, right? Around that 1830 kind of mark. That's at 1835, just a little bit above it, depending on where you want to draw it. But it is in that 1830-ish kind of range. Where you've got big, a hole that was filled here, right? Yeah. Came back, bit of resistance come up here, filled it in, did the S bend, off it went straight through. To me, that's stop action. People stop out on the way back, comes back, has a bit of a pause, a few other, stops coming in, short covering, and off it goes again, just triggering stops. So I think that the price action here is a combination of Ukraine and people stopping out. It's a big macro trade. A lot of people looking at that war. It makes the gold market very poppy, and that's really what's going on. As I said, for gold, to me, you've got to look at it on a weekly basis because it's such a macro thing. I'll be wary about going long just because the way in which these things, you can see it's very short, like it's 2 weeks max, all these things, that's like 3 or 4 weeks. The way in which it has historically over this whole move come back very quickly and come back a long way. Okay, so that's why I'd be very wary about getting long here. I think you'd really be wanting to have like some good weekly closes like further above this. And let's face it, if it really is off to the races, it's going a lot higher, right? So there's plenty of time to get in on the long trade. I'm still at a short basis because I think the interest rate and inflation story is going to last longer than a war between Russia and Ukraine. Right? Russia and Ukraine is driving it higher. Interest rates is going to drive it lower. What do you think is going to last longer? The Fed and their interest rates, or the Russia-Ukraine debacle? Famous last words, right? Because the US was in Afghanistan for 20 years or whatever, right? I do think this one is different. That's really the transaction that you're kind of looking at. Do you want to buy into like the short-term Ukraine-Russia story, in which case you buy it? Do you want to buy into the Fed raising rates, crushing inflation, in which case it's a sell, but being very wary of the spikes on the short term noise. Look, that's about it for gold. I'd be wary of this one. I'm skeptical, but I don't have a position on like I'm out. I'm just sitting there waiting. Okay, have a good one. Catch you later.